Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial mysteries of the corporate world. And today Valero Energy is giving us a little peek behind the curtain, or should I say, a slight update to their financial curtains. Get ready, because we are diving into a very timely report from Valero Energy Corporation. It is not exactly a bombshell, but it shows how even giants in the energy sector are constantly tweaking their financial setups. And for those of you who love getting the inside scoop on how these big companies manage their money, make sure you're subscribed. Also, we've got a fantastic community over on Discord where we chat about these filings and much more. The link is in the description below, so come join us there. So, what is the big news from Valero Energy Corporation on this particular October day in 2025? Well, it looks like they've done some important reshuffling with their borrowing power. Imagine Valero as a giant truck that needs a lot of fuel to keep running, and sometimes it needs to get a flexible loan, kind of like a credit card, to make sure it always has enough. That is basically what they've been up to. They've taken an existing credit agreement, which is like a formal promise to borrow money under certain rules, and they've updated it. This is a brand new loan, but a refresh of an old one. Think of it like renewing your phone plan, but getting better terms. The most significant change is they've extended the deadline for when they have to pay back the money. It used to be November 2027. And now it is pushed all the way out to October 2030. This tells us they are planning to keep this line of credit open for a longer time, signaling a stable outlook on needing access to funds for a while. This revamped credit line, or facility as they call it, is good for a whopping $4 billion. That is a massive amount of money. It is like having a super-powered credit card for the company, allowing them to borrow and repay as needed, up to this huge limit. This flexibility is key for a company like Valero, which operates in a business that can have big swings in costs and profits depending on global energy prices. On top of that $4 billion base, they've also built in an option to increase that borrowing limit by another $1.5 billion. So, in total, if they really needed to, they could potentially access up to a staggering $5.5 billion. This flexibility is like having an emergency stash of cash ready to go if unexpected opportunities or challenges pop up. It shows they are thinking ahead and want to be prepared for any scenario. Now, let's talk about the cost of borrowing this money. Valero has a choice. They can borrow based on something called the Term SOFR rate, which is a benchmark interest rate related to short-term borrowing costs, plus a little extra. This extra amount, called a margin, can range from 0.9% to 1.5%. This margin isn't T-fixed. It actually depends on how well the credit rating agencies like S&P, Moody's, and Fitch think Valero is doing financially. If their credit rating is good, the margin will be lower, meaning they pay less interest. It's like getting a discount on your loan because you have a great credit score. Their other option is to borrow based on something called the alternate base rate, which is another way of determining interest, plus a much smaller margin ranging from 0.0% to 0.5%. Again, this margin is tied to their credit ratings. This option often involves a higher base rate but a lower added percentage. The company will choose whichever option is cheaper for them at any given time. This is smart financial management, always looking for the best deal. Besides the interest they pay on money they actually borrow, Valero also has to pay a fee just for keeping this borrowing option open. This is called a commitment fee. It is like paying a small fee to have access to your credit card, even if you don't use it. This fee ranges from 0.1% to 0.25% per year, calculated on the total amount they could borrow whether they used it or not. This fee also changes based on their credit ratings. So a better rating means a lower fee. It is a cost of maintaining that financial flexibility we talked about. There are a few other smaller fees involved too. They have to pay fees related to letters of credit, which are like guarantees that Valero will pay for something. Think of them as a promise to pay if another party doesn't. They also pay a fee to the main bank, JP Morgan Chase in this case, that manages this whole credit agreement. These are standard costs of doing business with large financial institutions. So, what will Valero use this money for? The report simply states general corporate purposes. This is a pretty broad term. In the context of a company like Valero, this usually means funding their day-to-day operations, making investments in new projects, paying for maintenance, or even potentially buying back their own stock. It essentially gives them a financial cushion to handle whatever comes their way. Overall, this filing isn't about a sudden financial crisis or a boom time. It's a procedural update. It shows Valero is proactively managing its financial structure. By extending the maturity date of this large credit facility, they are demonstrating confidence in their ability to manage debt over the long term and ensuring they have access to funds. This is a sign of stability and good financial planning, allowing them to focus on their core business of refining and marketing petroleum products. When we look at the bigger picture here, Valero is a major player in the energy industry. They own and operate refineries and are involved in the distribution and marketing of transportation fuels and other petrochemical products. Companies like this are sensitive to global oil prices, regulatory changes, and the overall economic demand for energy. They are constantly navigating a complex market. This credit agreement update suggests they are preparing for a stable, or perhaps slightly uncertain, future where having readily available funds is a strategic advantage. Analytically, this filing is like a checkup for Valero's financial health. While it doesn't reveal dramatic shifts in performance, it confirms that the company is well capitalized and has secured its access to significant financial resources. The extended maturity date on their credit facility indicates foresight and a strategy to lock in favorable borrowing terms for the foreseeable future. In the volatile energy sector, this kind of proactive financial management is a strength. It reduces the risk of being caught off guard by unexpected market shifts or rising interest rates. A notable risk for Valero and the entire energy sector continues to be the transition to renewable energy sources and increasing environmental regulations. While this filing doesn't directly address that, ensuring strong financial flexibility is crucial for companies that might need to invest heavily in adapting their infrastructure or diversifying their product lines in the coming years. The opportunity lies in their ability to leverage this financial strength to invest in cleaner technologies or more efficient operations. In conclusion, Valero Energy Corporation's latest filing is a quiet but important affirmation of their financial strategy. They've reinforced their ability to access substantial funds with extended repayment terms at competitive rates that are tied to their creditworthiness. This positions them well to navigate the ongoing complexities of the energy market. Alright, that is our breakdown of Valero Energy's recent financial maneuver. What is your take on these moves, and what do you think they signal for the company's future in the energy landscape? Drop your thoughts in the comments below. If you found this deep dive into Valero's finances valuable, please hit that like button and subscribe for more regular corporate analyses. Don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching, and we'll see you in the next video.